We now move on with our afternoon with a conversation that I believe sits at the heart of the forum's mandate. Africa has no shortage of energy resources or project ideas. I feel like this idea has really been hammed into all morning. The real bottleneck is often risk. Our third panel today focuses on the financial instruments, policy frameworks, and risk mitigation strategies that can move projects from concept to bankable reality. And to moderate this conversation, please help me by applauding my colleague to the stage, broadcaster at SABC, Oliver Dixon.
Thank you so much, ladies and gentlemen. Welcome. It's always a problem when we have a session after lunch because it's all the non-Africans who choose to eat the pap. Um, and then their energy is flat, and I can see some of you have already had a little bit too much pap. But hopefully we'll be able to wake you up with this session. We're talking about money. That's why we're all here. I love talking about money. We need a lot of it. Minister Mantashe and his colleague are trying to raise 2.3 trillion rand in South Africa over the next 15 years. A lot of that capital will come from the people in the room, a lot of bankers in the room, and some of my panelists have deep pockets as well. So I want to welcome them onto stage right now. And I think there's been a few changes to the panel, but I think it's a fascinating mix of interlocutors who will give us different perspectives of what capital risk as well as the mobilization of resources look like. Some of them are just getting mic'd up at the moment. But I want to welcome them onto stage as they're ready. Samira Mensah is the Managing Director of Research and Analytics Africa at S&P Global. I'm very happy to have her here. They just gave us a ratings upgrade. Grab a seat right at the end. Thank you so much. That ratings upgrade is going to do us a great deal of good. Yeah, certainly. We're going to talk about that. We're going to talk about that. Dele Kuti, who is the head of the global head of energy and infrastructure at Standard Bank. He really loves it. His boss had a lot to say about it. We're going to be talking about that as well. Lida Pramer, who is the founder, CEO, and CEO of Solander Capital, is joining us in this panel. Let's give Lida a big round of applause. When Donald Trump said they'll not be participating, it didn't mean all Americans. There are a few in the room. One is on my panel. Let's welcome Bryce Dustman onto the stage. Bryce, Global Managing Partner at Strick Capital. Thank you so much. Grab a seat.
No, I'm going on. Oh, is this one?
Look, we're going to jump straight into this. I don't think there's a lot of time to waste. Because when we do speak about capital, I think it's important that we get it right. In fact, there's one more panelist who I had completely forgotten about. He was bullied onto this panel just as he arrived, by the way. He wasn't meant to be on the panel. He was forced by his brother. And so I want to welcome Kola Kareem onto the stage. He's the CEO of Shoreline Energy International.
Hi, good to see you. Yeah, good to see you.
Whenever Kola's in the room, he doesn't have a real designation. He does everything because whatever he touches is quite important. Glad to have him on the stage as well. We're going to jump straight into it. Capital is needed, but we're told that Africa is a high-risk market, a high-risk environment. And we're often told that if we're going to get it, we're going to need to mitigate the risk, and we're going to have to manage it better. But more importantly, we're also told that the debt, and if we're talking about debt in this instance, is incredibly expensive. So I want to start with you at the end, Samira. You quite literally measure debt and risk.
That's what we do.
Yeah. What is the African story? What are the indices and input factors into how you determine the risk profile of a project, of a country, of a market, and of an initiative?
Thank you. Thank you for inviting me. I know I'm here representing certainly S&P Global Ratings. Hello, NJ. Honorable Minister, I'd like to also salute you, all protocol duly observed in the reverse order, obviously. Look, it's extremely important. The African story, when it comes to credit story, is extremely diverse. We have had some positive momentum this year. Upgrading lately, indeed, South Africa to a double B plus on the local currency, so it's just one notch below investment grade. We are still 2 notches below on the foreign currency rating. We are certainly seeing some momentum also elsewhere. Morocco is back to investment grade. We have upgraded Egypt as well to B level from a low rating, given the debt story and the cost of funding, as you mentioned, Oliver. We are back on a positive outlook in the Nigerian story. This is a country that is dear to my heart. And so you see that essentially we are, despite essentially the challenges that have been persisting because of the vulnerability of African sovereigns to external shocks, because there is clearly a lack of financial buffers and a lack of macroeconomic stability. We have essentially, seen some progress being done on fiscal consolidation, on policy reform, implementation. That is the case of South Africa, certainly. And the other thing is certainly the fact that access to markets, despite being difficult, has enabled some of these sovereigns and corporates to essentially make progress when it comes to policy
Let me
implementation.
double click in on that because when we talk about these external shocks, they don't affect Africa singularly, right? They affect the whole world. Russia invades Ukraine, the whole world has an energy crisis. Trump has
Yes.
an onslaught of tariff trades against the whole of the world. Everybody gets hit by it. Africa's not hit uniquely. Why are we so vulnerable and susceptible more than any other market?
So we-
Especially when you look at an inflationary rally that leaves our currencies a lot weaker in external markets.
Yes, but you see, you can't talk about Africa in one single
Right, yeah.
group. We have 54 countries. Just if you take West Africa, Nigeria versus WAMU countries, they don't have the same macroeconomic dynamics, not at all. And if you ask any WAMU country, perhaps none of them would want to be in a single currency market with Nigeria, because the WAMU Union has macroeconomic stability, while Nigeria macroeconomic stability is extremely volatile because of the monetary policy settings, the policy implementation at large. The economic dynamics are completely different because it's a hydrocarbon driven type of economy because of the revenue it generates that are essential to essentially drive investments. So we can't talk about Africa,
Right.
just Africa. It's 54 countries. I'm Algerian. Algeria, it's a hydrocarbon economy as well. And it's not in the same state as Nigeria, which I know extremely well. So you see what I mean? So I think we should stop amalgamating. Yes, Africa, it's a big continent, but it's not one country.
Just one more. Earlier on, Minister Mantashe had suggested the idea of a ministerial forum across the continent where ministers could harmonize their approach to our energy and our mineral resources in particular. Is that the sort of approach that you think, the harmonization approach, one that would de-risk capital?
I think, frankly, the integration of the policy making across the continent will be beneficial to advance economic development. And Honorable Minister Mantashe actually has pointed something that is quite urgent to execute and accelerate on. Yesterday, S&P Global and Badia have launched actually their inaugural Africa Summit, talking exactly about this, Honorable Minister. And we've had actually the pleasure and the honor to welcome the Honorable Minister Gondwana to exactly discuss this aspect. And I think, yes, integration is absolutely essential going forward to essentially implement, because it's time to execute and implement ideas. We have debated those plenty, I think.
Yeah. Dele, I want to bring you into the conversation here. You're a banker. You don't like risk. You want to see returns, however safe and minuscule they may be, as long as you see them and you're able to actualize them. So the idea of a project to be bankable is critically important for you. What do you mean by that? And does bankability apply uniformly across all different markets?
No, thanks. Thanks very much, and thanks for having me. And a very great pleasure to be here, African Chambers, for inviting me. and all protocol observed with the Honorable Minister being here. Interestingly, I was at a session with DMRE like 2 weeks ago with the comfort of the Honorable Minister. So when it comes to bankability, I mean, it's clearly the same whether you, in terms of fundamental, whether you looked at it in Western Europe or you looked at it in Africa. The fundamental of bankability is the fact that, when you do have a project, you want to be able to ensure that those funds that are deployed, whether in form of equity or debt, you are able to kind of recover that. But there are clear fundamental things that kind of make it difficult, in Africa. Because the underlying risk, the market structure, and the institutional capacity that is there to be able to do transaction, of sizable nature is quite important when you look at it. And, as Samira mentioned, people look at Africa as, just one country, which is not. It's 54 countries, different things, in different markets. I'm in Nigeria and I'm responsible for global energy, global energy and infrastructure for Standard Bank. And I remember when I tried to start soliciting capital to support various projects, people don't want to talk to me about Nigeria. Southern African analysis is quite, very instrumental into what we see. We are funding projects in Mozambique. We're the largest funder for that project. In South Africa alone, based on the policy and the structure that the government put in place, especially to RPP, is a project to make sure that power in South Africa, we facilitated, close to $2 to $3 billion of investment into that. We were able to deploy those capital because of the policy and the structure that has been put in place. We couldn't do the same in Nigeria. I couldn't do the same in Zambia. You couldn't do the same in Zimbabwe. In fact, we're only able to start facilitating deployment of capital into Zambia when they decided to go through what we call an open access, which kind of allow independent power generation to then be able to, use the resources that they have in there to be able to get it done. So the bottom line I'm trying to say is the fact that the structure of the utilities differ from the market. The utility in Europe and America, they are all investment grade entity. An offtake contract from some of those entities are easier to be able to, to bank. When you looked at, start supporting projects in this part of the world, you will see, promoters asking for sovereign guarantee because of the challenge of the regulatory changes that can happen, in this type of market. The other bit of it is also is further when you look at bankability, because it's a combination of, whether can you recover your money, what are the risks related to, to that particular project. In most of the projects that you see in some of the continents, there are clear currency risk that come with those into that transaction. Foreign exchange risk in terms of course, some few countries are actually getting out of the challenges on the foreign exchange, that they have in there. When those things are not there in Western country, you are doing a project in UK, you are doing a project in the US, those elements are actually not there. You are quite comfortable with the regulatory environment that, is predictable, you can work with it. The capital markets, it also differs. When you looked at, West and the US, they have a capital market, where people can get 8 years money or 20 years money. That impact bankability. What is bankability? I give you money, can I get it back in 5 years, in 7 years, in 10 years? When we're in a position where you can deploy a long-term capital of 15, 20 years, you see the repayment required at this early stage is different from, when you start thinking about, the government in this particular country is only there for 5 years. And when the new government comes in, you're just going to change and cancel all the existing contracts. So those are those things that the banks then, factor in. But however, for Standard Bank, unfortunately for us, we only do business in Africa. We're the largest bank in this continent. So we really leverage on our local knowledge and engage with our team, to see how we can work with the DFI, to then see, how you can bring concessional capital to make some of those projects bankable, where a mix of funding, to can crowd in those capital are actually, the key things that we do. So fundamentally, it's the same, but the risk make a difference in terms of how you see it play.
Yeah, I mean, you have the biggest balance sheet by asset base on the continent. I'm curious, does that make you more risk averse, or does that open you up to a greater deal of risk appetite?
So the first thing for us is the fact that when we looked at the continent, our purpose as Standard Bank is to drive the growth of the continent. That's the purpose. So how do you drive the growth of the continent? You focus on supporting the energy, we focus on supporting the infrastructure, which interestingly I'm responsible for those portfolio today. So one of the key things that we looked at is how do we then deploy the capital and crowd more additional capital to be able to make sure that we can support a lot of projects. So we work, with a lot of institutions to then make sure that we continue to drive those opportunities. Africa is big, whether it talks about the gap of between 120 to 170 billion require on an annual basis to support infrastructure is there. So the key things we're doing is to continue to be able to see how we can deploy more capital to be able to support that. So it's a huge opportunity that we see in the continent. Of course, it's interesting that we're seeing that our rating is clearly changing in the continent. We need to continue to find a way how we can continue to make sure that we can drive, capital to support projects. Africa is big with a lot of opportunity, and that's what we see.
Leader, interestingly, Dele speaks about instruments that help de-risk, that makes them excited, such as sovereign guarantees. You bring in private capital. Does something like that make you excited about the concept of shared risk when you approach a project?
Absolutely. And really, it's about blended finance. With blended finance, we know that it works. What we need to do is scale it. And so I was on the Finance and Infrastructure Task Force, the B20 task force this year. And actually, I think I have to just step back a second and say to the Honorable Minister and Executive Chair, Njay Ayuk, thank you very much for having me here today. Apologies for not going in order for that. But the Finance and Infrastructure Task Force, what we looked at and the recommendations we're giving to the G20 governments is threefold. So we look at the source of funds, the use of funds, and the flow of funds. So it's really about the expansion of investable projects, because in Africa, 90% of infrastructure projects drop off between the planning stage and financial close. And that's due to lack of regulatory consistency, poor planning, and also lack of coordination between investors and government. And so we're trying to actually change that. So the expansion of investable projects really means expanding the G20 infrastructure hub. I mean, who in this room knows there's a G20 infrastructure hub? One. And two. And so what this is, it's supposed to be a mechanism for countries to go to and for investors to go to, created by the G20, where there are already projects that have had some of this planning. But this also, it goes to government regulation and policy, for example, so the permitting process. For example, in Canada, we have this year, within a few months of taking office, Prime Minister Carney took a look at what projects are going to be of national interest. And Canada is very much like all of Africa. We're very resource rich, so we're big into mining and oil and gas. And for us, they were taking 5 years for projects to be permitted. Now, there's no investor out there who's going to say, yeah, I'm going to give you money today, but 5 years from now, let's see if you actually get a permit. How do you do that, right? So what they did was they took a look internally at the government and what are the processes? What here takes so long? And so they managed to scale it back for some of these projects from 5 years to 2. And it's not because they decided to jump over any, or rather to decline any regulatory or environmental permits. What they did was they looked and said, we're going to look at our approval process in conjunction with each other versus consecutively. So that way they were able to trim off some time. So I'm going to just keep going on some of the other G20, because the other thing is the increase of access to capital. And so this is where you were making the comment of when you have a syndicate of investors, it brings in that de-risking. So what we also did for the first time this year in the B20 was to bring in philanthropy. So now we have public, private, and philanthropy working together in some of these blended finance. Now, everybody here is probably thinking, why do you need donations to some of these big, in oil and gas and mining? Why do you need somebody to donate money? Yeah. But what we don't realize, and the reason that philanthropy was brought to the table this year, is that they are more than just grant givers. They also bring knowledge, they work with the local partners, they have patient capital. And so on the grant side, they can actually bring in, or they can take in first loss, which then de-risks it for the private sector. It allows scalability for the private sector for more to come in because they can take that first loss. But more importantly, what I didn't know, and I'm pretty sure most people don't know, is that globally, philanthropic organizations have $500 billion in assets under management. So they're not just donating, they're actually also asset managers, so they're investing at the same time. And so lastly, just for our third recommendation was enhancing the flow of funds. And that's the capital markets, making sure that there are more mature capital markets, making sure that payment systems work, and especially for small and medium-sized enterprises and micro as well, which is the lifeblood of any economy. But it's all about partnerships.
It's important as a Canadian when you sit next to an American to remind them that Canada's not for sale.
Elbows up, right?
I don't want to buy it.
I just want to stick with you for a second, Lida. South Africa has a platform and an instrument called Operation Vulindlela, means to open the door. We love operation names. We're great at coming up with them. And what it effectively is an instrument to achieve exactly what you're describing, a sort of synchronized instrument where permitting, for instance, and the policy and regulations around permitting can be streamlined to get rid of some of those impediments and to get rid of this syncopated approach at getting things done. First you do this, then you do that, and then you do those things sequentially. Congo has a similar instrument. Angola has a similar instrument. In the presidency in Namibia, there's somewhat of a similar instrument. And we're seeing more of these pop up across the continent. I don't know if you've engaged in any of them, but are we getting it right?
I honestly don't know because I haven't gotten engaged in any of them, but it really is about doing things more efficiently, which, my apologies, Honorable Minister, but the government isn't always the best at doing things efficiently. So what you have right now is you needed it. We've heard this all day today is you need an enabling environment, which the government creates, which then gives private sector the ability to be innovative, which then attracts the investment into that innovation. The problem is that the government doesn't work that fast. And so if the government can take an introspective look, so there's two things, take the introspective look and see where, maybe the policies of 1975 no longer work in 2025. But also, we need to incentivize some of the mature industries if we want to bring in the new technologies to help as collaborators and enhancers to some of the old industries versus looking at it as maybe we bring in a policy and then the private sector follows. Because technology, green tech, climate tech, AI, it all moves at the speed of light. And so governments have to be able to also move a little faster. Whether they will or not, that's the question.
Kola, when we speak about risk, we often talk about the things that could go wrong. But what is the African story that's important to remember when deploying capital, the things that do go right? And what is it that those with a checkbook in the room need to consider, even against the risk story that the capital effectively will lead to profitability?
Thank you very much, and good afternoon, everyone. I think there's a very core factor that needs to be taken into place, and that's reputation of the promoter of any venture on the continent. It doesn't matter what it is, if the reputation of the promoter is solid, then bankers and investors will look at it in a different light. I'll give you an example. In 2011, a small Nigerian oil company approached what is the largest bank on the continent. And Dele, correct me if I'm wrong, Standard Bank supported us with $850 million. And I believe that's still the largest single obligation on the continent. Not to the global greats on the continent, but to a Nigerian company. And that's because we had a bankable project. We had a transaction that's feasible and it's win-win. And more importantly, it's supported with credible promoters around it. That's very important. The other thing we shouldn't forget, Africa is a land of opportunities, but those opportunities can only come into play not by us sitting behind and waiting for global investors to crowd along. We need to do something. And what has happened over the last 10 years is African financial institutions have come of age. So you see banks on the continent with single obligor limits that's now increased because of the investment base. And that in itself, if you're hand holding some of these guys, would attract other global investors to support this project. A key area that you need to think about is Africa's position is clear. Very distinct economies, 54 nations. Very diverse in our construct, but we're very unique and unified in one thing, and that is infrastructure. So my focus is the heavy duty infrastructure on the continent that needs to be put into play. And a typical example is we are involved from the energy side, oil and gas, and the infrastructure build out side. We're building the Kano Maradi rail, which is the first interconnecting rail between countries in West Africa. So Nigeria connecting all the way to Niger. And this is all, we approach the international ECAs, and at the end of the day, having spent 9 months of lots of money spent, lots of time spent, what did we get back from them? Risk. And what are these risks? Oh, there's Boko Haram in northern Nigeria, and we are not comfortable. What did we do? We went and focused on the African financial institutions who understands Africa risks. And we took them through the projects line by line. With the support of the Nigerian government, that project is fully funded, $2 billion, and not one European ECA in it, only African financial institutions that's made this work. But let me tell you what's happened. So when we talk about risks, what is inherent and important is ability of the promoter on this side in making sure the counterparts on the other side who are, look, capital is looking for returns, but you need to convince them that your investment, be it debt or equity, is safe. And that's what it is. We now spend time on the road making people understand that, look, today the Kano Maradi project alone employs 5,600 Nigerians, 165 expatriates. And in that region, any incursion from Boko Haram and stuff is now down to 10% because people are busy working. Idle hands, you know the answer. Yeah. So risk.
Do those that deploy capital think about the social element in the way you're talking about it right now?
No. You need to explain it and make them understand it. It's a schoolboy game. But I tell you what, look, reality is you've got an investor who's got debt instruments sitting in Oklahoma or sitting in Canada. The closest position of Nigeria is on the internet. And they're trying to make decisions to fund a project, rail project in northeastern Nigeria. What do they do first? Google. And if you Google northeastern Nigeria, what's the first thing? Boko Haram, terrorism and stuff. Would you, in your conscience, put money there? No. So it takes us, as promoters, as Africans, to make sure those who are willing and able to invest on the continent understand the inherent, not risks, but situations and positions in these economies and in these localities, in making them understand it's not all lost because you have a counterparty that would help and government that will support to make a difference.
Can I hold you on this because I want... Right, so I'm going to get to you in a minute, but Samira, I want you to respond to this quite directly. Does your risk model calculate the social cost of inequality when thinking about the bankability of projects?
Yes, it is part of the rating. As you know, all our ratings are based on methodology that are transparent and published, and anyone who wants to essentially go through the methodology can get to the rating plus or minus one notch, to be honest with you. And it's based on data. And the data, when it shows that it has social consequences, that could trigger essentially fiscal expenditure to rectify these social inequalities or social needs, then it will have bearings on the rating, right? Because we assess, for instance, for a sovereign, that part which is the so the balance sheet of the sovereign, and then on the other part, of course, the economic prospects. So the combination of the two, the data actually will transpire and will lead to whatever is out there in the economy, in the social fabric.
Yeah.
So absolutely, it's grounded in data. Now, is the data perfect? No. Are we improving on the data? Yes, thanks to particularly on the deal flows and the transactions. The GEMS database, which is the global emerging market database, that has shown essentially that the recoverability on projects actually has been way higher than what, let's say, global data and ratings have suggested. We have implemented essentially changes to some of our methodology, the multilateral methodology, to essentially take that on board. And so as that database is being fed by multilateral and perhaps tomorrow by commercial banks, that will improve the data strength and ratings ultimately.
Yeah.
So yes, data is absolutely powerful.
Yeah, Bryce, we're often told that deregulating is a panacea to freeing up capital. And when you walk into a deregulated market, you can deploy your capital with greater flexibility and ease. And that's oftentimes a good thing, attractive to investors. And then we're told Africa is highly regulated. We're being told that about South Africa in particular. Minister Mantashe told you about all those NGOs dragging him to court every time they try to drill in the Orange Basin. And it's part of the highly regulated environment. Is it true that deregulation should be an approach to be considered by markets on the continent in freeing up capital flows?
In response to your question, how many in the room have one of these?
Oh,
Everybody.
I was with the Commerce Committee when we totally deregulated mobile communications. It is now ubiquitous in the world. Everywhere I go in Africa, people have cell phones. You leap to technology. That's what deregulation does for you. When you have regulations and you have government, basically all you're doing is redistributing wealth. New wealth is created by the people in this room.
Yep.
Natural resources, agriculture, forestry, fisheries, mining, oil and gas, that's where new wealth is created. That new wealth then allows a country to build infrastructure, to do things for people that don't have jobs in economic development. That is what happened in the United States. It's what will happen eventually in Africa. All regulations do is slow down that growth and slow down that progress in reality. I just want to tell you a little bit about my firm. Our ethos at Strict Global Diplomacy, and we've worked in East Africa, West Africa, South Africa, the northern part of the continent. We work in the Middle East and Latin and South America. Our ethos is we want to help countries modernize, not westernize. We don't care what your culture is. We don't care what your beliefs are, but we believe that in order to improve people's standard of living and increase the GDP of a country, that you need to modernize. And the way that you modernize is by investment of capital. Bring capital in for your projects and things like that. I just want to touch on your comment about the terrorism. We believe that terrorism is an economic issue.
yep.
The point that he made about your project, creating jobs, if you create jobs in an area where there's terrorism, it gives them an opportunity to do something other than to take up arms and kill people. That's extremely important. We do a lot of counterterrorism work, and we help countries basically with intelligence, training, and the tools that are needed. We worked with Kenya for 8 years. They've had 2 terrorist attacks that each cost them $1 billion to their hard currency. So that's the response to your regulation problem.
Yeah. Kola, do you agree?
Yes. Look, the core of major problem spots on the continent is poverty. And if you could fix poverty either on a rising scale, we fix majority of the problems on the continent. If you look at, there's an important inflection that people don't think about. If you look at the largest economies looking at the continents of the world, there's a correlation between the size of the population and that economy. So look at South America, Brazil. What do you have? Large population, large economy. Look at North America, the United States. Same thing. If you look at Asia, India, China, same. But Africa, what's gone wrong? So I always go back and look at a country like Nigeria. Large population, huge natural resources, 47 billion barrels of 2P reserves of oil, 210 TCF of natural gas. It's absolute madness. We shouldn't be playing where we're playing. But the game is changing. The focus is there. In 2005 in this country, there was the South African-Nigeria Commission meeting. We were talking then about the South African power pool, the West African power pool. 20 years on, what's happened? Zero. We talk the talk, but we'll never walk it. So if we have leadership with focus and purpose, you have the African entrepreneurs with determination to make it happen. That's the difference.
May I follow up on that? The model in the United States, one of the strengths of the 50 states is if one state we try something and it doesn't work, it doesn't harm the rest of the states. But if you try something and it works, all the other states copy it. The same thing, I think, eventually will happen on the continent of Africa. The solutions are not from outside this continent. They're actually in this continent. What will happen is there will be countries that will be successful in improving their standard of living, increasing their GDP, creating jobs and things like that. And the rest of the countries in Africa, because you all do communicate with each other, you have a similar background, they will begin to copy that. And when people ask me, what's the future of Africa, I think it's actually within Africa. Yep. The United States can play a role in that because we have access to capital and we have capital to invest. But to understand the way the United States invests capital, it needs to be secure and safe. And you need to be able to show a ROI, a return on investment. There's two bankers in this panel. My experience with a banker, I was a CFO of my family's farm corporation at 22. When I went into the bank, I had to show that I had collateral and I had cash flow. I had to show that I had skin in the game, and I had to show that I could pay back the loans on a reasonable terms. That's the basis of raising capital. In the United States, it's exactly the same thing. There's interest both from our government. We've shifted from a model, foreign policy model of doing things with you, of doing things for you to doing things with you. It's like the parable that Jesus, give a man a fish, feed him for a day, teach a man to fish, feed him for life. That's the role that the new administration wants to play with Africa, and we can help in that endeavor.
Dele, you work in the capital markets, which is perhaps one of the most highly regulated sectors in the world of any sort. So you're not averse to regulations, but do you think that policy, resource, and energy regulations on the continent are overly regulated in a way that it hinders and hamstrings capital?
No, thanks for that. I think the most important thing when you look at the regulation, important to understand that this is important, is critical for the element of this to start growing. And our work and engagement with various regulators has kind of shown that when you clearly engage with regulators, they're able to create those enabling environment to kind of allow it to happen, and that's the way we kind of see opportunity in the market. I mean, we're talking about social impact earlier before. When we ask in a number of projects, there's a need to have ESG. People focus on environmental only. ESG is environmental, social, and governance. The social aspect of what that brings to the table is quite important. I mean, we are clearly supporting the project in Mozambique today and the gas project because we believe that the between 20 to 30 billion dollars of investment into that market would change the country, from low income or poverty-driven economy into a middle income, which is quite massive. When you look at the project in Uganda, the pipeline that's going to take oil from Uganda into Tanzania for the production, and the NGOs were complaining about it. I was showing someone today that the NGOs were still in my office in Standard Bank, Rose Bank. Yesterday, they were there. for testing. But you realize that the economic impact of that project kind of translate the entire East Africa that you expect it to grow from 5 to 7%. So there is no need for us from our perspective that, so for us, what we see is engage the regulators, let them understand what is required, and we need regulators to actually enable private sectors to be able to drive opportunity in the market.
Yeah. Lida, I want to ask you the next question, but I'm being nudged by a few people in the room to ask some questions. I wasn't given the leeway to do that, but I'm going to see if we can get a roving mic around, and we'll get some questions in from the audience if possible. Lida, do we deploy innovative instruments in when we think about important transactions on the continent? For instance, is there a willingness for foreign exchange hedging on the continent to ensure that when we think about challenging market environments, that we're able to mitigate some of that macro risk? Do we think about, you spoke about blended finance earlier, do we deploy blended finance instruments often enough? And is there an appetite amongst the different types of partners and stakeholders who put their money and skin in the game, so to speak, to explore innovative financing instruments?
I think the easy answer is yes, there is the appetite to explore. What needs to happen is we have to expand the pool of people that are in that investor pool. So, for example, I was in Seville, Spain in July for the United Nations FFD4, Financing for Development. This was the first time business was invited to FFD4. And so we actually had some closed-door roundtables with the asset management community. We added in philanthropy. We had the banks. And we talked about creating blended finance and infrastructure finance as a new asset class in order to bring in some of the smaller players. Because some of these larger projects, they need the larger players. But their capital isn't endless. You need to bring in some of the smaller players, but how do you do that? You have to pool it together. So we have to provide an opportunity for the people who don't know how to do this to be able to get involved, and that way to increase, that's the way to increase scale. But the blended finance does work. And one other thing, because I know you're about to say something, but on the philanthropic side, there's actually a statistic where if philanthropy gets involved, the success of projects actually goes up to 70-80% of getting through to closure.
Just on that, when private capital typically gets involved, they ask themselves the question which Sebastian Wagner's in the room has $7 billion of a balance sheet right now to deploy, but he's always thinking about his exit point. And you argued earlier that philanthropic capital is patient. Do we have the right sort of timelines when we think about the African story in terms of how long do I stay in this? Or is the exit point question a fair question to ask?
Listen, investment doesn't chase hypotheticals. We've already talked about it. You need to have a return. There is a mismatch between some of these longer projects and the timeline for reporting, because when you have shareholders, you have quarterly reporting, typically if you're a public company. If the private capital, if you're an asset manager, might have reporting as well. If you're a sovereign wealth fund, you've got a little bit of leeway. But if you're a pension fund, you have to be very careful about risk, because you can't turn to a pensioner and say, sorry, there's no money because we invested in something because it's the right thing to do, versus if there's going to be a return. But when you have patient capital, so that's family offices, it's philanthropic money, sometimes it's high net worth individuals. The patient capital has the ability to stay in the game for longer periods of time to see through the life of the project.
Yeah. Unfortunately, we're terribly over time and out of time. I thought I was going to take some questions, but I've just been signaled that we absolutely can't. I see 4 hands up in the room. I'm going to ask my bosses in the back if I can. They're standing right there. Can I take 3 questions? Okay, she says yes, so I'm going to take 3 questions. Your hand was up first, your hand was up second, and then I'll take the gentleman here. Unfortunately, the 3 hands in the back, I'm not going to take. So if we have...
You got the minister.
Minister Mandashi can invite you to dinner and ask you these questions. Okay, I'll make an exception. One last. So can we get the mic in the room? Is there a mic? Do we have a roving mic? Great, it's coming. I'm going to need you to stand up. We've got cameras. You look really pretty. We need to see that you were here.
Oh, no. Sorry, it's not about that, and I really would like you to pay attention to what I'm about to say. So I'm Miriam Taylor from Angolan origin, born in exile in Portugal. So given the Africa's energy and tax systems, capital markets still carry the imprint of colonial era infrastructure and financial risk models that undervalue African-led initiatives. How can investment frameworks be redesigned to actively dismantle these structural inequities? And what concrete mechanisms would ensure that African communities become true co-owners rather than mere end users of the continent's energy, tech, and financial transitions? Thank
Brilliant
you.
question. I'm going to hold it and then I'm going to take the share. Please do stand.
Thank you. Thank
Tell us
you.
your question.
Yeah, my name is George Sibulela. I'm the president of the African United Business Confederation. Mine is directed to Samira. Samira, I used to serve on the Council of BRICS for Business for South Africa. Very important discussion on our working group, the financial services industry. I'm just going to ask you specific points in relation to rating agencies. One, it says the BRICS countries, they say these rating agencies, the three of them, as you know them, including S&P, they are perceived geopolitical and ideological bias. Secondly, lack of representation and voice for emerging markets. Thirdly, pro-cyclical rating behavior. 4, lack of transparency in methodologies. 5, the impact on sovereign borrowing costs, and particularly for African countries.
Yep.
Slow recognition of reform progress, over-reliance on Western macroeconomic standards. So they represent the Western and the US, not so much the African countries, to suppress the countries for borrowing, for more borrowing on the IMF. Potential conflict of interest, systematic concentration and lack of competition. And lastly, necessity for a fairer global financial architecture, which means the three control 90% of the world, which becomes absolutely very unfair. And you know that BRICS, in fact, is considering to start their own rating agencies.
I think that point has been captured. Really love it. I love the Mabutu 2 piece. Can we get the? There's one last this way, this direction. That's the last hand, and then the minister that I recognized. I'm going to ask you to keep it very brief and short, my good sir.
Yeah.
Good afternoon, everybody. My name is Tato Mazwe Madibo. I am the CEO of Imvula Investment Group. My question is, given structural risk premiums imposed on African markets, to what extent can de-risking instruments shift investor perceptions, and how can continent design on sovereign and regional multilateral tools reduce dependency on external credit ratings while accelerating infrastructure project progression? Thank you.
Okay, and the last one is to Minister Mantashe. He's standing up for us. Pagamata.
No, they are Pagaman man is the biggest risk facing the continent not the strong negative narrative that undercuts even positive developments. I'm making this point because I caught your point when you said West Africa power pool, Southern African power pool, and you said it's zero. And my understanding is that Southern African power pool is working. The only difference is that South Africa is having over-concentration of energy, but it's interconnected. That's why when we had load shedding, we had to source electricity from all the neighboring countries because we are interconnected. So therefore, the risk to me is negative narrative dominating Africa. Every positive thing is seen as not. Nobody talks about South Africa having moved from 34% access to electricity in 1994 to 94% access to electricity today.
Thank you very much.
I'd love
Really
to answer
appreciate
that.
it.
I'd love to answer that.
So, Samira, I'm gonna let you go first, and I think I'd like you to respond to the first two questions because I think there's a great synergy between what those questions were aiming at.
How long do we have? So I'm not going to go point by point, sir. But I heard you, and when I didn't have the mic live, I was saying it was a fully loaded question. So now, look, I think I've addressed the fact that methodologies, as far as S&P Global Ratings is concerned, and I can only talk about S&P Global Ratings, are published. It's transparent. They have been so for a long, long time to make sure that essentially anyone in this room can read them and replicate a rating at plus or minus 1 or 2 notches. So it gives you a very good idea of where we're going with that. We are rating through the economic cycle to essentially give visibility to investors, global investors, to make investment decisions. The role of credit ratings is not to do everything for investors, is to reduce friction in the markets and reduce information asymmetry for everyone who has fiduciary and invested interest to essentially make informed decisions. It's not the only factor that is being used by investors to make their decisions. They use other they use other characteristics as well or conditions. Now, welcoming other credit opinions is a good thing, and the creation of the African Credit Rating Agency, if it provides and contributes to a deeper and more granular credit narrative, it is welcomed by investors. I'm sure they will welcome it. It's not for me or for S&P Global Ratings to decide on how to perceive other rating agencies. You know, we are not the only one. Yes, we are the foremost provider of credit opinions and second-party opinions, but we are not criticizing any other credit provider, or other credit ratings provider. So it's extremely important to understand that these are opinions based on data, and we publish every rationale why we decide on a rating. We haven't been negative all across, but indeed some sovereigns, some companies have seen negative rating actions because of a number of issues around debt, around cost of debt, sustainability of debt, debt distress. You know, out of 54 countries on the continent, 10 are in debt distress, according to the IMF. 10 others are in very high risk of debt distress. So that's 20 out of 54. Yeah. So it's a lot. And then you still have actually a bunch that are managing through. And you know, the latest decision, and I think South Africa is one good example where policy implementation has essentially led to fiscal consolidation and rating improvement. So we move on the rating. We move on the rating of Côte d'Ivoire. We moved on the rating of Benin, which is a tiny economy comparatively to South Africa. We moved on the rating of Morocco. Yeah. So it's not all negative, absolutely not. Where there is progress, there is recognition. Yeah. But indeed, sir, you are right. When there is a rating downgrade, indeed, it takes time actually to come back up. It takes time because, yes, moving a ship around it's not easy.
Yeah, look, I'm going to have to end it all here. We have gone terribly over time. Because I know you wanted to answer to and respond to the minister.
But Olivia, I'd like to add one point, but I think is important.
Very briefly, please. Very briefly.
There's an investor perception. South Africa, triple minus rating. Brazil, triple minus rating. They put Eurobond in the market. And the Brazilian bond was 3 times oversubscribed than South Africa. Same economy, part of BRICS, part of everything. So the investor perception do have a lot of things into this, and those are this narrative, as the minister is saying, that we need to make sure that we correct from time to time.
Yeah. Thank you very much. Give them a big round of applause, everybody. Really do appreciate it.
Thank you, Oliver.